Well, for more on Greece and indeed where the rest of Europe is heading, we can now speak to Azad Zangana, Schroder's chief European economist. So let me just start by asking you about sentiment on the markets, the launch of the Greek rescue plan. It really doesn't seem to have inspired a great deal of confidence.
Not yet. We're not out of the woods, of course. National parliaments still need to ratify the bailout, which should happen over the coming week. And there's still slightly more debate finalising some of the details. But hopefully that should all be in place by Friday's ECOFIN meeting.
And what is the feeling with regards to the possibility of a default or restructuring?
Well, in the short term, that fear should be going away now. But of course, there are still very large structural problems that will be in place. Greece's debt is expected to reach 150% of GDP sometime in 4 or 5 years' time. And so that's still quite a large amount of debt that's going to be hanging over the country.
And how will the European Central Bank's decision to keep taking Greek government bonds as collateral for loans going to affect the single currency?
Well, of course, it's the reversal of the promise made by Monsieur Trichet that no single country would receive special treatment. Now, of course, that's been put aside in order to look after the prospects of the euro. And, of course, without a euro, there's very little point of a European Central Bank.
And so what does this mean? I mean, is the European Central Bank going to have to eventually resort to buying government bonds, or is that a red line that the German government wouldn't allow to be crossed?
Well, at the moment, the European Central Bank is not allowed to buy government bonds in the primary market. They are, of course, allowed in the secondary market, but you're right, it is an absolute red line for the German government. It's something that's going to have to be considered as we progress through this crisis. If the situation improves, then perhaps there won't be a reason to purchase those bonds.
And what about the risk of contagion? I mean, you mentioned it briefly there. Some would argue we've already seen evidence of that in the credit downgrades that we saw for Spain and Portugal last week.
Potentially, but I believe that credit rating agencies tend to be a laggard indicator rather than a leading indicator. And if anything, they were responding to the situation in Portugal and Spain that's actually been apparent for a number of months now.
European officials have been very keen to draw a distinction between Greece and the situations in Portugal and Spain, saying that you can't make comparisons. Is that the case?
Well, you can make comparisons, but the thing is that they are very different countries. Heading into this crisis, Spain and Portugal had far lower levels of debt and far lower deficits as well.
It's interesting that we saw something of a rally in Greek government bonds on the back of that rescue package. I think we saw a chart just a little earlier there, even showing the yield on Greek 10-year bonds just coming down a little bit there. What can we read into this?
Well, there is some return of confidence. It will be interesting to see whether those yields come in further throughout the rest of this week. And I think we're seeing a bit of a Jerry Maguire moment at the moment. The market's just saying, show me the money.